Welcome to our analysis of JX Metal's two-decade evolution from a commodity smelter into a pure-play advanced electronics ecosystem. This journey is more than just a rebranding. It is a systematic alchemy that shifted the company's core from basic metal refining to the very heart of the semiconductor architecture. Today, we will deconstruct how they successfully escaped the gravitational pull of their former parent, INEOS, to unlock a massive valuation premium. We will also map the next frontier, a specific roadmap of 10 strategic Japanese acquisitions designed to secure end-to-end dominance in surface chemistry and niche metallurgy. By understanding this trajectory, we can better appreciate how a focused portfolio, rather than diversified bulk, drives outsized investor returns in today's specialized materials market. This slide outlines the three strategic pillars that underpinned JX Metal's valuation leap. Pillar 1 focuses on the financial mechanics. By shedding legacy zinc and lead smelting and spinning out from the INEOS Energy Group, the company effectively removed the, quote, conglomerate discount, creating a standalone market cap of 3.7 trillion yen. Pillar 2 illustrates their M&A blueprint, where they moved from being a price taker in bulk commodities to an ecosystem owner. Key integrations like HCS TaNb, Tatsuta Electric, and Toho Titanium allowed them to own critical layers of the supply chain. Finally, Pillar 3 looks forward to the PE target roadmap, the 10 final missing links required to close the loop on proprietary plating chemistry and advanced recycling. When we compare the circa 2000 baseline to the current FY 2024 to 2026 profile, the shift is staggering. 25 years ago, the core identity was a passive bulk smelter of copper, zinc, and lead with an operating profit of roughly 10 billion yen. Today, JX Metals is an independent, 3.7 trillion yen market cap giant, producing high-tech sputtering targets and advanced compound semiconductors. Note the financial profile. Revenue has surged to approximately 1.5 trillion yen, supported by an operating profit of 86 billion yen and an EBITDA nearing 100 billion yen. This transition from a commodity price taker to a high-tech proprietary ecosystem owner is the engine behind their current market-matching valuation with their former parent INEOS. The data on this slide visualizes the financial reward for strategic focus. By 2026, JX Metal's standalone valuation reached 3.7 trillion yen, nearly matching the 3.9 trillion yen market cap of the entire INEOS Energy Group. This was achieved by ruthlessly removing the conglomerate discount through a strategic separation from the parent organization. The operating profit scaled 8.5x because management shifted capital allocation away from low-margin refining and toward high-margin electronics materials. This isn't just growth. It is a re-rating of the entire business. Investors no longer see a metals firm. They see a critical materials partner for the global technology industry, allowing for a tech-focused premium that was previously obscured by the legacy energy and mining divisions. This visual represents the radical cleanup of the portfolio. In 2000, 85% of the business was weighted toward base metals and smelting, including zinc, lead, and basic copper. By 2025, that pillar has been marginalized in favor of high-growth sectors. Today, 30% of their focus is on semiconductor materials like sputtering targets and powders, while another 35% is dedicated to information and communication materials, such as specialty foil and wiring for 5G and EV batteries. JX Metals leveraged the semiconductor boom by becoming a top global supplier of sputtering targets used in wafer fabrication. This shift entirely away from basic commodities ensures that their margins are driven by technological scarcity rather than fluctuating LME metal prices. Transformation requires liquidity, and JX Metals utilized a divest-to-invest playbook to fund their push up the electronics value chain. A pivotal moment was the 2022 sale of their stake in the LS Nikko Copper joint venture. By liquidating this multi-billion-dollar stake in traditional bulk copper smelting, they generated the capital required to target highly specialized, high-margin capabilities in the global semiconductor supply chain. This move signals a total departure from the volume business of the past. Instead of owning the entire mountain of ore, they decided to own the most sophisticated processing steps that turn that ore into advanced technology, a strategy that significantly improves return on invested capital, ROIC. Since 2018, the pace of targeted tech consolidation has aggressively accelerated. The timeline shows a shift from general reorganization in the early 2000s to surgical M&A in the last decade. The The 2018 acquisition of HCS TaNb in Germany secured high-purity powders, followed by the 2024 TOB for Tatsuta Electric, which added critical wiring and foil expertise. Most recently, in 2026, the impending full acquisition of Toho Titanium secures the raw material supply for their dominant titanium sputtering target business. This sequence demonstrates a clear trend. JX Metals is no longer just buying companies, they are buying the physical layers of the semiconductor architecture to ensure they are the sole source for their customers. This slide illustrates how strategic acquisitions were precisely targeted to capture sequential physical layers of semiconductor architecture. By bringing HCS TaNb in-house in 2018, they secured the high-purity tantalum and niobium powder production required for capacitors. The 2024 acquisition of Tatsuta Electric secured downstream EMI shielding films and specialty wiring indispensable for high-speed data transmission. Finally, the 2026 integration of Toho Titanium ensures a stable, ultra-pure raw material supply for their world-leading sputtering targets. This vertical integration reduces dependency on external suppliers and allows JX to capture the value add at every stage of the manufacturing process, from raw element to finished component. Beyond external acquisitions, JX Metals also optimized its internal structure to eliminate friction. Between 2022 and 2023, they absorbed their plating and coating subsidiary, JX Metals Foundry, into the parent company. Previously, this external boundary caused delays and added costs between base material production and final surface treatment. By internalizing these foundry operations, specifically the plating tech at the Isahara and Hitachi plants, they improved processing efficiency and permanently secured essential intellectual property. This direct integration of surface treatment into the core business ensures that their most sensitive plating technologies remain within their own walls, providing a moat that is difficult for competitors to replicate. Despite their current dominance, our analysis identifies one final white space gap: proprietary chemical processing. As shown in this closed-loop ecosystem, JX Metals controls the raw metals, Q1, the component manufacturing, Q2, and the finished downstream products, Q4. However, they still rely on third-party vendors for the specialized plating solutions and surface chemistry, Q3, that bond these layers together. The final frontier for total ecosystem control is acquiring proprietary plating solutions to eliminate this reliance. By internalizing these chemical recipes, JX can close the loop entirely, commanding absolute pricing power and enabling end-to-end innovation in the next generation of global semiconductor and telecom infrastructure. To close the identified gap, we have synthesized a matrix of 10 specific Japanese acquisition targets. These are categorized into 3 strategic functions. Cluster 1 focuses on mastering surface chemistry, with leaders like Nihon Kōjun Kagaku and Okuno Seiyaku. Cluster 2 fills capability gaps in niche raw materials and manufacturing, such as Nippon Tungsten for CVD processes. Finally, Cluster 3 focuses on closing the loop through advanced recycling and equipment bundling with firms like Sanyu Techno and Hamada. Integrating these players would allow JX Metals, or a PE partner, to rapidly expand vertical scope across the entire value chain, moving from raw materials to advanced chemistry to the equipment that applies it. Target Cluster 1 is the most critical for completing the value chain. By targeting companies like Nihon Kōjun Kagaku, JX gains upstream control of precious metal plating solutions, gold, nickel, essential for PCBs. Shimizu Corp provides eco-friendly, non-cyanide electroless copper plating tech, meeting tightening ESG standards. Okuno Seiyaku Kogyo captures high-end wafer bump plating, while Nippon Kagaku Sangyo expands their reach into advanced surface treatment chemicals. Finally, a carve-out of Dowa Metaltech's electronics materials unit could consolidate the Japanese plating industry. Together, these 5 targets transform JX into a plating chemistry hub, capable of offering a fully integrated, proprietary chemical and metal package to global chipmakers. Cluster 2 focuses on securing niche raw materials and specialty sputtering targets that are currently missing from the JX portfolio. Nippon Tungsten is a primary target. Tungsten is essential for semiconductor CVD processes and aerospace, yet JX currently lacks this material. USTRON adds proprietary manufacturing techniques for specialty silicide and nitride targets, marginally increasing overall market share. Chori Corp's inorganic fine materials division provides a strategic channel into specialized oxide materials and niche target markets. By integrating these specialists, JX ensures that no matter what material a client's next-generation architecture requires, be it titanium, tantalum, or tungsten, they are the only partner capable of supplying it at scale. The final cluster addresses equipment and secondary raw materials to finalize the lifecycle loop. Sanyu Techno is a unique equipment maker for semiconductor plating. By bundling JX's proprietary plating chemicals with Sanyu's equipment sales, the company can capture maximal value right at the point of manufacture. Meanwhile, acquiring specialized recyclers like Hamada Metal Recycling and Nakano Company secures a domestic stream of secondary raw materials such as aluminum and battery metals. This reduces upstream import dependency and ensures ESG compliance through a circular economy model. These moves ensure JX Metals isn't just a supplier, they are a permanent fixture in their customers' production lines and recycling streams. In conclusion, executing this targeted M&A roadmap will cement JX Metals as an unassailable global powerhouse in critical electronics materials. By utilizing PE-backed carve-outs or direct acquisitions to integrate these 10 niche Japanese players, JX will definitively close its value loop. The result is a vertically integrated giant that controls the raw elements, the proprietary chemistry, the manufacturing equipment, and the final component architecture. This level of integration allows for absolute pricing power and a locked-in relationship with the global semiconductor and telecom industries. JX Metals has shown that by shifting from bulk to bits, a traditional industrial firm can become the most indispensable partner in the digital age.